Welcome back to Market Dialogue. If you're new here, this is where we decode the market from a trader's perspective, not from a hype perspective, not from a get rich quick perspective, but from a place of real understanding. Today's video is special because it's our first deep dive session. We're going to spend the next 8 minutes unpacking something that 90% of retail traders don't understand: how liquidity zones form before major price moves, and why continuous call or put buying is often a trap, not a signal. This is about joining the 10% who succeed by learning to read what's happening behind the candles. So if you're tired of chasing trades and want to understand price action, you're in the right place. Let's dive in. Here's how we are structuring today's session. First, since this is our inaugural video, we're going to lay the foundation. I'll walk you through the core concepts that Market Dialogue follow, how we think about retail versus institutional behavior, and why that matters. Second, we'll explore the mechanics of liquidity zones. You'll learn how call and put buyers, that is mostly retail traders, unknowingly create liquidity pools that institutions exploit. Third, we'll look at real chart examples from the Indian stock market showing these patterns in action. And finally, we'll discuss risk management and strategic thinking because understanding concepts is useless if you can't apply them responsibly. Before we continue, let me be crystal clear. This video is purely educational. It's not financial advice. I'm not telling you what to trade or when to enter. Always consult a licensed financial advisor and do your own research. Trading involves significant risk, and no strategy wins every single time. Your trades are your responsibility. Got it? Good. Let's continue. To understand how markets really work, we need to simplify the playing field. Think back to high school math. Remember how we'd make assumptions to solve complex problems? We're doing the same thing here. For our learning framework, let's assume most retail traders are buyers and most institutional players are sellers. This isn't 100% accurate in every scenario, but it's accurate enough to understand the game, as there are hedge funds that come into picture, and yet we shall assume buyers are retailers, or people like every one of us with small to medium capital, and sellers, being smart or institutional traders, are always a step ahead in technology and capital management. Here's the harsh reality. In downtrending markets, institutional coal sellers profit while retail coal buyers lose. The statistics are brutal. Institutions win over 90% of the time, while retail traders profit less than 10% of the time. Why? Because the market isn't designed to make all participants profitable. It's designed to facilitate liquidity, and liquidity comes from one side losing so the other side can win. Now you might be thinking, but I'm careful. I use stop losses. Well, that's exactly what we need to talk about next, because your stop loss isn't protecting you the way you think it is. Let me paint a familiar picture. A retail trader sees momentum building. Maybe Nifty is showing strength or a stock is breaking out. They enter a call option position, feeling confident. They're disciplined. They set a stop loss below their entry and maybe a take profit target above. What happens next? Look at this diagram. About 90% of the time, that stop loss gets triggered before the real move happens. Why? Because most retail traders place their stop losses at the same obvious technical levels, below recent lows, below support zones, below round numbers. And here's the thing, institutions understand that retail doesn't. Those stop loss clusters represent liquidity. When price dips down to sweep those stops, it triggers a flood of sell orders. Those orders fill institutional buy positions at favorable prices. The quote on your screen says it perfectly. The market often moves to where the most stop losses are placed before continuing in the intended direction. Your stop loss isn't just protecting your capital, it's also advertising where institutions can find liquidity. That's the uncomfortable truth. Let me break down exactly how this liquidity capture mechanism works step by step. Step 1. Retail call buyers enter the market. They place their orders with stop losses at what they think are safe levels. Step 2. Institutional sellers execute those orders. They're facilitating the trade, taking the opposite side. Step 3. Here's where it gets interesting. Price deliberately drops below retail stop loss levels. This isn't random, it's strategic. When those stops trigger, retail traders are forced to exit, and that wave of selling feels the institutional bid side. Step 4. Only after this sweep of retail liquidity does genuine bullish momentum emerge. The real move happens after most retail traders have already been shaken out. The most painful part? Retail traders exit right before the move they were correct about actually happens. They had the right idea, but they got trapped in the liquidity sweep first. This is why watching continuous call buying doesn't mean what most people think it means. It's not strength, it's often the setup for a trap. This is the lesson I want you to screenshot, write down, and internalize. Continuous call or put buying does not equal directional strength. Instead, it often signals the building of liquidity zones that become traps for market participants. Look at this visual. When you see excessive call buying clustering in one area, that's not a signal to join the crowd. It's a warning that liquidity is building and smart money is watching for the opportunity to sweep those stops. The same applies in reverse with put buying during bearish phases. There's an old trading saying, the crowd is usually right during trends, but wrong at turning points. This is why. At turning points, the crowd's positioning becomes the liquidity that fuels the next move in the opposite direction. Smart money doesn't follow the crowd. They wait for these zones to form, then exploit them. Theory is great, but let's see this in action with real Indian stock market data. Look at this chart. See these two areas I've marked. These are call buying clusters, periods where retail traders aggressively bought call options, expecting upward momentum. What happened next? In both cases, price reversed. The first cluster led to a liquidity sweep downward. The second cluster is still pending a sweep. Notice the pattern. Rapid call buying, then sellers create a liquidity trap, then only after stops are hit, the actual directional move begins. This is why smart traders don't rush in when they see one-sided positioning. They mark these liquidity zones on their charts and wait. They wait for confirmation. They wait for the sweep to complete or for a clear rejection. Patience in identifying these setups is what separates profitable traders from those who keep getting caught in traps. Now let's look at the mirror image, how this plays out in bearish markets. Same concept, different direction. Put buyers see weakness and aggressively buy put options. They cluster their positions, all with stop losses at obvious levels above current price. What happens? A short-term reversal upward. This is the trap. Retail stop losses get hit. Institutional put sellers profit from that liquidity. Then and only then does the true downward move continue. Look at the 3-day sequence on this chart. Day 1 shows initial downtrend and heavy put buying. Day 2, surprise, price sweeps upward, hitting stops. Day 3, the genuine down move unfolds. The quote here captures it perfectly. True directional moves often occur after retail liquidity has been captured. Once you understand this pattern, you start seeing it everywhere, and more importantly, you stop being the liquidity. So how do you actually trade this? How do you avoid being the liquidity? First, never rush into trades based on one-sided price moves. When everyone's piling into calls or puts, that's your warning sign, not your entry signal. Second, identify liquidity zones. Mark where excessive call or put buying is happening. These are your danger zones. Third, wait for a clear break or rejection. Don't anticipate but always react to confirmation. Let the sweep happen first or wait for price to clearly reject the liquidity zone. Fourth, when you do enter, use tight stop losses and realistic profit targets. Maintain at least a 1 to 2 risk-reward ratio. And most importantly, stay objective. Prepare for both scenarios. Don't fall in love with your bias. Remember, patience and discipline are more important than perfect entry timing. It's better to miss a trade than to become the liquidity for someone else's profit. Market Dialogue is about building a learning-focused community, not a hype machine. I'm not here to show you flashy P and L screenshots or promise you'll get rich quick. I'm here to help you understand how markets actually work. Avoid anyone making exaggerated profit claims or pushing reckless leverage strategies without explaining the risks. I want this to be interactive. Share your setups in the comments, ask questions, challenge these concepts with your own observations. That's how we all learn. We'll be doing live Q&A sessions where we'll review real setups together, analyze what worked and what didn't. If you're gaining value from this type of content, hit the like button, subscribe, and turn on notifications. Help us build a community of traders who prioritize understanding over impulse, because that's what separates the 10% who succeed from the 90% who don't. Now let me show you a perfect real-world example of this concept in action. Reliance Industries Limited. Look at what happened earlier this month. Notice this cluster here? This is where we saw heavy call buying activity. Retail traders saw some momentum building and piled into call options, all expecting the price to continue higher. But here's where it gets interesting. What happened next? Exactly what we discussed earlier, a liquidity sweep. Price dropped down and boom, all those stop losses got triggered. The retail crowd that jumped in based on crowd instinct got stopped out. And this is the critical part I want you to see. Only after this stop loss sweep, only after the majority of retail traders were forced to exit their positions, that's when the actual directional move began. Now look at where we are currently. We're at a peak. And here's what's likely happening right now. Over 90% of retail traders have spotted this big bullish move. They're looking at these green candles, feeling the FOMO, and they're desperate to get in on the action. What does that create? Another cluster of retail call buying right up here at the highs. So what's the smart approach in this situation? Well, it's definitely not to jump into calls just because price is going up. Instead, this is where patience pays off. We wait, we watch for that retail cluster to get cleared out first. We look for confirmation of a pullback or consolidation. Only after we see most of those late entries get shaken out, maybe through a dip, maybe through a sideways grind that frustrates impatient traders, only then do we consider fresh call entries. And even then, we're looking for clear confirmation in our analysis, not just hoping for continuation. This is what separates reactive trading from strategic trading. Don't chase the move everyone else is chasing. Wait for the liquidity to get captured first, then look for your entry with confirmation. That's reading the market, not just reacting to it. Now here's where it gets really interesting. Let me show you Force Motors. Because not every stock behaves exactly the same way, and understanding why is what separates good traders from great ones. Look at what happened in mid-August. Just like with Reliance, we saw heavy call buying activity. Retail traders piled in, following their crowd instincts, and predictably, what happened next? Their stop losses got hit. The liquidity sweep happened exactly as we'd expect. But here's the twist. After the majority of retail traders exited, we were expecting the actual directional move to unfold, right? That's what happened with Reliance. But Force Motors, it didn't react the same way. Now you're probably wondering, why didn't it play out the same way? The answer comes down to something we don't talk about enough, the time factor. And this is actually a perfect segue. We're going to dive deep into time-based analysis in our upcoming Sunday educational slot. So make sure you're subscribed and have notifications turned on, because that's going to be a game changer for understanding these patterns. But let me give you a quick breakdown of what actually happened here so you can start thinking about it before that deep dive. After that initial call buying rally by retail traders, see it right here, notice what came next. Instead of immediate directional continuation, we saw a put buying rally in the counter trend. This is fascinating because it brings in a whole different concept, supply and demand dynamics. Look at these continuous lower lows forming. Each one of these represents put buying activity. And just like with call buyers, these put buyers also got trapped. Their stop losses got hit. You can see it right here on the chart, and that's when the actual downward direction began. So we had a double liquidity capture event. First the call buyers, then the put buyers. Both sides got trapped before the market made its real move. Now, where do we stand currently with Force Motors? Unless we see a strong rally with confirmed continuous call buying showing up in the lower time frames, and I mean genuine accumulation, not just retail FOMO, the expectation is that this downtrend continues. This is why you can't just apply the same pattern blindly to every stock. Market structure matters, time frame alignment matters, supply and demand balance matters. This is the kind of nuanced thinking that helps you avoid false signals and stay on the right side of the market. We'll break down the time factor concept in detail this Sunday, so you'll know exactly what to look for and how to adjust your analysis based on these timing dynamics. For now, the key takeaway is this. Always confirm what time frame the liquidity is building on and wait for alignment across time frames before taking positions. Don't assume every stock will behave identically. Read each chart independently. Alright, let's wrap this up. Remember, your trades are your responsibility, not mine, not anyone else's. Learn to read the market, don't just react to it. Take time to review what we covered today. Go back through your own charts and look for these liquidity patterns. mark the clusters, watch what happens next. Understanding liquidity is understanding the market. Once you see it, you can't unsee it. I'll see you in the comments section. Share your thoughts, your questions, your own observations, and I'll see you in next week's session where we'll dive into specific setups we have discussed now and even more for the upcoming week. Until then, decode the market, trade with clarity, and remember, it's market dialogue, not market noise. Check the description if you missed to understand a few keywords used in the video.